Welcome along. Tonight I'm going to go deep into the sale market and the rental market, and as well as go into the biggest performers over the last year and the worst performers, both in that sale and rental market. And then we'll also take a look at my top 3 predicted suburbs, which will be really good to cover off. And I'll go through a bit of my methodology for how I chose them and take you kind of behind the scenes into one of those suburbs to show you how I analyze the trends down at that suburb level in order to improve our chances of getting better than above average growth over the next year. So I'll launch straight into things, and the Perth sale market to start off with. Started including these trend lines to help us all, see when a trend changes and both when a trend's in place. And we don't ever want to look at what happens in any one month. What we want to do is observe over time, what's happening, because there's always little fluctuations in a market depending on its season. And so winter, we've had a really down and quiet winter. I don't know whether it's because it's been extra rainy and gloomy and everyone's just staying indoors more, but we have had a fair bit lower winter than normal. And what we are looking at here is our number of properties for sale. So you can see that we actually hit our peak, bottom of our market just by this indicator back in, we had the most on back there in November 2015 with 16,293. And we've slowly started trending back the other way. So that's, a good sign overall that the market is improving month on month. And you can see that we've hit a new low in the number of properties for sale this last month in August, with 13,256. So what that actually represents is we're down 9%, basically 10% on earlier this year in Feb. So that's a really good sign. But we're down 5.8% on the same time last year. I'm more focused on a similar time last year because we're both in the same season. So overall, we're down in the number for sale, so less properties out there. And that's only half of the equation. So when we look at numbers sold, we really need this indicator to turn around and keep trending back, up, because when both are going those respective directions, then we have an improving market, and it'll start to flow through to price. So what you can see in here is we have been dipping and bouncing off the bottom, but what is of concern with the last 2 months is we've hit 2 lows that are outside of that previous trend. So that really does concern me, and that's why we've still got mixed signals going on, and we can't say that we've definitely bottomed out yet. You can see that we had 498 sales, approximately around that 500 sales. This is sales per week. So the demand has been, lower than I would have expected. Last year at the same time, we were getting around 530 sales per week. So you can see that's a 2.73% decrease on last year. And we're down 24% in the number of sales that were happening per week compared to February. So I'm not as focused on the Feb comparison, more what we were doing last year. And we're there enough and similar enough, but we certainly aren't helping the reversal of this trend. And we have been making slight improvements month on month, as you can see. Coming back, our overall demand, number of properties being sold, coming back up month on month, but we're really going to have to see how we go into spring coming up, and June, July, August is our winter. And when we usually go into September, we usually have a lot of properties coming onto the market for sale. So this will jump up. But what's really important to see is if the buyers also come out, and whether we see this jump back up in line with our improving trend, or whether we start, heaven forbid, going back the other way. So it's really going to be a very important next 3 months when we head into spring. So if you are thinking of selling a property, spring is a much better time to sell than the last 3 months that we've been in, including this month. I've got a lot of owners that I'm working with at the moment to bring properties up for sale. So just getting them ready. And in this market, buyers are very fussy. So it's worth, getting things to an overall even standard and improving them so that they can't point at, problems and get the price as high as possible when we do sell. Of course, if you can avoid selling, if you've got an investment property, I would look at avoid selling unless you've got another opportunity to take. If you're a homeowner, it's more than okay to buy and sell in the same market, because then what you might miss out on yours, you're usually upgrading into an upper price bracket, so you should be able to make more on the purchase, save less on the purchase in the higher price than you would lose in the lower price when you sell. I hope that makes sense. So now, when we take a look at the days on market, this is continuing to trend upwards. We've had, it started to come back down from, we were at 67 days back here in the September quarter of last year. We dropped down to 62, 63 days in December quarter, then we bounced back up, and so we're really continuing to trend this up. We need to see this breakthrough, and this would be the other major indicator we'd need to see before where we could say that we've bottomed out and turned. So we're currently at 68 days for the average property to sell. And the median house price, so price is always the last indicator that would show up and turn. So the stock on market would decrease, the number of sales would increase per week, and the days on market will decrease, and then finally we'll see the trailing indicator of price finally come back up. So this is continuing its sharper decrease down. We've hit a new low of 505,000, and interestingly enough, we were kind of at about this level back in March quarter of 2013. So with a lot of my appraisals that I'm doing for people every day, I'm kind of actually looking back to March 2013 as a guide for price as well. Often if people have bought, you can imagine if you've bought in any time after then, if you've bought in this period in here, the scary thing for a lot of people that have bought in 2014, 15, and even 16 is they can be in a negative equity position if they haven't bought well. Of course, if you've bought well and you've saved 40 or 50,000 or whatever the price may be, that can kind of insulate you from a market if it does pull back a bit. So yeah, very much on par with that 2013 level. Now, when we look at our biggest winners over the last year, it's very easy to think that no suburbs are improving and nothing positive is happening when we look at all the media. And I know I just painted, a pretty negative picture still for the most part. But there are some suburbs making their recoveries, and they're mainly in this $800 to $1.1 million price range still. And they were the best performers that we saw over last year as well. And so that price bracket's still continuing to recover. The reason for that is we've got people that are upgrading from that $600,000 to $800,000 price point into these, seeing really good value in these blue chip areas. These top end suburbs had fallen the most, and as well as the bottom end suburbs had suffered the most. and now we've got people continuing to buy in because they see value. You can see some really big jumps over the last year in these really blue chip areas like Cottesloe, like Adderale, Shelley, etc., Wembley Downs. So it's double figure, improvements in those suburbs. I've excluded any areas that don't have enough sales to be credible. So I look for at least 30 sales to, really ensure that we're not just, looking at false data. And then when we look at the lower three gains, two of these areas actually feature in my top predicted areas because I believe they've still got some more to go. Safety Bay and Mundaring, particularly, I really like the look of. I'll go into a bit further on why later on. But it's good to see that we've started to have some recovery and growth coming down to more of these middle price points, which is the price points that I, really do prefer because they are insulated a lot during these more turbulent times. So what we will continue to see happening is the ripple effect flow down from these topper suburbs down to these middle priced suburbs, and then the lower end will still be a good 18 to 24 months away before there's any kind of correction when we look at the suburbs below 400,000. So you can see we've had a good mix of recovery there. When we look a bit further back in time to see that there actually has been some suburbs that have grown quite reasonably on average over the last 5 years. I meant to highlight this column here, the 5-year column. You can see that some of them haven't performed as well over the last year, but we can see that we still had reasonable performance on these upper end areas. So some of them, even though they've taken a little bit of a dip, on average they've performed pretty well over this period. I'll just see if anyone's got a query. No queries there. Jeremy, if you had a question, type it into the question box as well. So that's more of the 5-year point. You can see Riverton has done, particularly well, and Willerton, and both of those areas are very sought after for their schools, funnily enough, with the Ross Moyne and Wilson kind of school catchment zones in those areas. So that's, I would believe, is a big reason behind their gains, as well as Shelley in there. So when we, and Ross Moyne's featured too, right there. So you can see that when we look at each of those areas, they're all kind of backed by that. We've also got the coastal appeal that's kept up North Beach and Trigg, and Wembley Downs to some extent over on that side. And then we've got that real blue chip Shenton Park and Swanbourne areas in South Freo. So they've held up very well over the last 5 years, all things considered. Then when we look at the biggest losers, this tells a bit of a different other picture. I had a bit of a laugh, and I hope no one owns a property in Kenwick. My head office is in Kenwick, and it's why we only manage 1 or 2 properties here. It's really suffered badly house price wise over the last year, dropped 17%. You can see some of the other areas that have had significant decreases. So that gives you a feel that if your suburb's not listed there, then the decrease is likely to be somewhere in the more in the single figures, hopefully. But generally, for the most part, 80% of the market would have dropped over the last year. Don't quote me on that figure, but it's in that order. So you can see when we scan through here, we've got some newer areas that have had an oversupply of housing. So that's the Brabham and the Jindalee and Warnbro, all suffering because they've had too much land come on, and buyer demand hasn't kept pace with it. We've also seen some pullback in Kalamunda, which I found to be surprising because it does, it's usually holds up pretty well up in the hills there. But as I looked into the suburbs surrounding it, it's just that people have seen more value in the Lesmurdy and Wollaston suburbs, and there's been a bit of a correction to Kalamunda there. And Lathlane, I found that surprising because of its location and all the positive things happening with the stadium. So I think I'd really have to look much deeper to try and figure out, and I think it will be a bit of a blip. And you know, at 650k, a lot of us would have to think that Lathlane is still very good, you know, value and buying at that, especially with the stadium opening shortly and all the expansion and stuff that the Crown Casino is doing. So I think that's a bit of an anomaly in this group. When we then go across to units, so that was all about houses. When we go across and take a look at what the unit market's been doing, now the unit market is a good 12 to 18 months behind the house market. So if you were going to buy an investment property, I would certainly be staying out of the unit market for quite some time, unless it's got a reasonable land component like a villa or a townhouse. Apartments are going to really struggle as a general comment. You can see that they met their peak of median price in June 2014. So, and then you can see that we've had some very uppity down and quite sharp dips over the last few months and quarters, sorry. We're now down at 407,000 median price. And when we look at the biggest winners, what this is made up of for units is some real kind of blue chip areas that are holding up well, and apartments and units are continuing to be sought after in. Featuring in the list as you scan down, every one of them is a really established and decent blue chip area. The only exception would be Rockingham, and that's holding up really well down there too, and must be continuing to have some good demand from the industry side of things down there, as well as retirees moving down and seeing value. So yes, looking there, you've got your West Leadables, your South Perths, your Mozzie Parks. A lot of the units in these areas are older, but really close to amenities, and we've had some newer apartments and stuff come on there, and they've continued to be sought after because of their really great blue chip locations. So they've done pretty well still over the last year. When we look at biggest winners over 5 years for units, you can see again that the blue chip suburbs feature. It's very quite a few of the ones that have performed well over the last year are in this list for the 5 year. You can see Vic Park, yes, it's tapered off a little bit over the last year, but on average it's done very well over this 5 year period. Scarborough, Freo, Applecross, good blue chip suburbs that have done well. So when we look at biggest losers for units, you can see that these figures are a lot higher on average compared to our houses pullback. And that just goes to show that there can be a lot more volatility in units compared to houses. Baldivis has pulled back and been affected the most, with some of the units that got built down there around the town centre, pulled back a massive 27%. Ouch. Doubleview, which has been, really popular along with Scarborough over time. I think it just overshot itself for price a bit and has had a correction. We then go through and look through some of the others. Bayswater, interestingly enough, is in here for pulling back for units. I think that is more representative of some of the older units that have become less favourable in there. And then when we go through, we can see, some other areas that are a bit more surprising that have pulled back, Morley and Inglewood. So, that's our biggest losers for the last year. Now, let's take a look into the rental market. We've got a very unique perspective because we do manage in 167 odd suburbs, a bit of a map on the right of where we're looking after properties all over Perth, down from Mandurah in the south up to Alkimos in the north. This map actually needs to go further. So I have a good overall broad view, and I've got my finger on the pulse of what's happening. When we look at the number for rent, we've had a good general decreasing in our number for rent, which is encouraging. The trend has been generally down, and you can see that most importantly, we're down at 10,600 properties on the market for rent. We're down on where we were at a similar time last year. We had 11,500 properties for rent. So that's really encouraging to me, and we always expect more properties to be on in the winter months. As you can see here, as you can see back here, and as you can see it go back up here back in July. There's always a little an extra decrease. So hopefully this trend will continue in the number for rent. I've got my fingers crossed it will. When we look at the rental vacancy, again, like our sale market, the rental market's showing very mixed signs in its indicators still. The vacancy is still trending up, which means that there's more and more properties staying vacant on the market for longer. And even though our number for rent is coming down, so what that means is that the underlying demand from tenants is decreasing and not as strong, and that would be because we've got tenants leaving the state to move interstate for other jobs. We've had tenants, a flurry of tenants, and I suspect the greatest reason for this spike, look, we were actually starting to trend downwards up until May. And I was starting to see, really see some positive signs that we'd turned. So once we have all indicators adding up, then we can say that we've hit the bottom of the rental market. But what actually happened is we had our state government decide to give us the first home buyer boost end date, and it artificially caused every first home buyer out there that was ever thinking of building to rush in and get their $5,000 extra grant. And so a lot of tenants have either moved back in with home, and it takes 12 months for that to wash through as well. So we're probably not going to see the full effects of that until another year's time down the track after they've built. But many of them, have to move back home or move in with other people. And I guess winter, you can see as well that we've generally had a spike up in winter for vacancy, and we've really hit a new high. This is the highest rental vacancy that we've ever had in the time that I've been recording things. So 7.3%. which is an increase on February by that same amount, and an increase by 21% on August last year. So that is still concerning to us all and who are investors across Perth. The median rent, now we've been at $350 per week for the last 3 months. And again, this is a trailing indicator. The other ones will respond first, and then the rental price will show up last. So I actually think this will drop a little bit more before, and we'd need these to start coming back the other way before we're going to see any this bounce back up again. You can see that's a very firm trend downwards that we've been experiencing, and I'm just glad that it's stuck here at 4 months, but it'll probably take another few dips over before the end of this year. So when we look at areas most affected, now I can't actually get data down at the suburb level for rental. I just don't keep it and report it Rewa does an awesome job with their data, but just don't have it down at the suburb level. But we do have by region, and it gives us a good feeling for what's been happening in the rental side over the last year. So you can see the Armidale area, Armidale Serpentine area has been affected the most, with an 11% drop over that period, going from 365 to 325, and it dropped quite. It's still on par to drop 3% in the last quarter, so it's still dropping at that same rate, which is scary. So it does show that it's got some more to go. And then the other most affected area, Belmont region, there was a real supply that kind of came on of apartments, which saw a lot of people stop living in the houses side. And with the oversupply in the apartments as well, you'll see with the units side, Belmont's also dropped 14%. I'll come to that in a sec. When we scan down some of our other areas that have been affected most, Gosnells, which is, you'll notice that a lot of these are the far outer areas. And as a whole, the Perth metro region, when we look at the average, has dropped 8.2% in rent over the last year. So when I look at our property portfolio, we've got 570 properties under management, and our portfolio that we manage and it's very broad, as you'd imagine. So we've actually dropped from 470 per week to 380 per week now. So a bit bigger drop than this 8.2. So yeah, it's concerning for all of us, and we hope that it levels out. And what we have found with our portfolio, at least, is that month on month we're starting to level out and drop by much less. Over the last 6 months, we've dropped by 4%, and over the last couple of months, we've dropped by 2.5% to 3%. On track to drop by 2.5% to 3%. So it's slowly leveling out, but certainly hasn't bottomed yet. We do have the occasional property that we're increasing the rent on, which we ring a little bell and get all excited about. But we've still got a bit of ways before we get to the bottom. Units, you can see that Wanneroo South region has copped a really heavy drop in its prices, 22%. There's been a bit of an oversupply in that area that's caused that. Rockingham Kwinana region has really hurt at 14%. Belmont, as I mentioned, and then Bassendean, Bayswater, and then there isn't any area that has not been affected. So when we look at Perth Metro, you can see that apartments have dropped by approximately 11%, and houses as an overall have dropped by 8%. So houses generally have held up better than apartments, and it's interesting that with both sale and rental, apartments are generally more volatile in Perth. So that's another, notable point when assessing what type of property to get into when you do buy. So I hope everything's making sense. If you do have any questions as we go, I've got one here. Areas in Joondalup suburbs. Is it still worth buying in newly rezoned areas in the Joondalup suburbs? What I'd suggest with looking at those is you really need to get down to the suburb level, and I would look at specifically, is there profit in the individual properties that you're buying? I would choose the suburbs carefully based on a deeper analysis of the trends in that suburb. So I would look at days on market and trend in price and trend in the stock on the market for those suburbs. And I'll show you how to do that a little bit later on when we look at our predicted suburbs. And we will, I would then suggest that when you're looking within, so narrow down your list of 2 to 3 suburbs that are trending the right way, so that you align your longer term and shorter term trends, so that it's not going to go backwards on you. And then when you look in those 1 or 2 suburbs, look for something that has the return as if you were taking it through straight away. So you'd want to find a 15% plus return to take it through straight away. And then if you buying with a good return today and the market is likely to continue in that direction, you'll be best placed for not going backwards and making money. So let's continue to move on. If anyone has a question as we go, chime in. I'm just going to now look a bit at the larger perspective of timing the property clock. So Perth has still continued to stick at this, approaching the bottom of the market phase. We've had a few suburbs change over the last month. We've had Sydney jump into starting the decline. If you joined us for our Australian market update, we were mentioning that we felt Sydney was further around. You can see that Alice Springs has officially reached its bottom of the market, and Southwest they actually had put that as starting a recovery, but I think that was a bit premature to be saying that for the Southwest. But Perth still much back here. Last month we did say that areas that most investors are looking at is in Brisbane and areas like Hobart. Melbourne is approaching its peak, and we've got Sydney, really going to start coming off the boil. So when we look at the unit market, you can see that Perth is still back here in a declining market. So that just substantiates what I said earlier about the unit market trailing the housing market and being 12 to 18 months away. You can see a few changes and to things that they highlight. Sydney again has moved to a starting decline phase. So my top 3 suburbs, and what I've done to select these is I always prefer that we look within 20% of the median price for Perth, so that insulates us when the market is going through times such as these. So that with our median price being at 505,000, that means we're approximately looking between 400 and 600. I selected Woodvale as my higher price suburb because it just really stood out to me. I also then go deeper to look at rental yield, and I would like it to be at least 4% or above. There's many suburbs at around the 3% mark. So that just means that we're not losing too much per week when we compare what we're getting for rent compared to our loan. And then I look at vacancy rate, most importantly, so how difficult it is to find a tenant. And I try to choose areas that have got a less than 3% vacancy rate and the vacancy rate trending in the right direction. So you can see that Woodvale's at that 3% mark. And then with growth, what I do is I look into the trend in the current, in the underlying indicators, and I'm not as focused on what it's necessarily done over the last year, but I do look at where it's been over the last 5 years, and if there's a discrepancy on that, then it makes me even more confident that there'll be a bit of an upkick. And as is the case with both Madeley and Woodvale, they haven't performed that well over the last year, but they're really starting to get primed for an upkick, I feel. And Safety Bay, interestingly enough, is my bottom lower price suburb. That's had a lot of retirees uplifting that, as well as the pull from the Rockingham and other industrial areas down there. So it's actually performed very well over the last 5 years with 3% average annual growth rate, and it's actually had one of the higher growth rates in the last year as well. Good rental yield and the lowest of the vacancy rates of these 3 suburbs. So that's my top 3 as they look now, and the kind of time frame I'm expecting for you to see, growth is over that kind of 12 to 24 months period. I wouldn't look to get in and out any sooner in property, and very much buy for the longer term. Now, these are just my my suburbs that for general buy and hold investing. If we were covering off areas for development, that would be, I'd have to give you a few other different areas, and I've actually got a seminar coming up, a webinar coming up on that again next month, which I'll tell you about shortly. So, does anyone have any questions? Please chime them into the Q&A, but while we're getting any of those, I'm going to show you how I analyse at the suburb level the indicators, and just show you for one of the suburbs. I think I've got Natalie or something ready to pop you through. Yeah, so Natalie, this is one of the tools I use called Boomtown. There's lots of different tools around. This is one that I have access to. And you can see that the demand to supply ratio in Natalie at the moment is rated to be 34 out of a possible 48. So that's in a good market where this is actually labelled as being a seller's market. So this just goes to show that even within a downward buyer's market that we're in at the moment, there are suburbs that can still be in a seller's market. And I mentioned that there's probably 20% of Perth that is in these kind of markets, and that may be surprising to a lot of people. So as we actually look into the stats as to why, we can see that we've got, I'll just take you through some of them, and what I'm again more interested in is the trend in the stats, and as they start to tighten up, then that's when we see a change in the typical value. So days on market, Manly. If anyone doesn't know where Manly is, it's up north next to Darch and Wangara, still pretty close to the CBD and slightly inland of the freeway near Hepburn Ave. So you can see that 78 days on the market compared to our 68 days average in Perth. So that's still, still not super tight. Rental yield 4%, which I mentioned. The stock on the market is relatively low at 2.5%. So once that gets below 2%, that's when we really see it affect price and start to kick up. If we're at 1% or 1.5% or less, then we'll definitely see price increase. And vacancy rate 3.2%. So what I'm actually really interested in is the trend in underlying indicators. So what we can see here is the demand to supply ratio. And so this is how much demand there is compared to supply. And you can see that since November last year, we've started to trend up month on month. And we're now at that, getting into that really place where we start to see pressure on price at as we are in July. And then the underlying things that we look at for that, we'll take a quick look at typical values. So that is still actually falling slightly, but what gives me confidence in this area is our days on market is trending downwards. We were at 100 days 100 days back in November, so that is trending downwards. And when we look at stock on market, you can see again that is trending downwards. So providing these two trends in stock and days continue, then we will see the typical value lift and boost. And the reasons that I'm really favourable on this, when we compare with all the other many other suburbs in the same price point, it's got a very healthy rental yield and a very healthy vacancy rate. So referring back to earlier, the average vacancy rate in Perth is 7.3%. This is half that. So it's a much healthier rental market, a much tighter rental market in Natalie. So likewise, I could go through Safety Bay and Woodvale, and you would see a very similar trend in its indicators for both stock on the market and days on market. When those are trending down, you see price, like once they get tight enough, you see price likely to increase over that 6, 12, 24-month period, and that's why I've listed these 3 suburbs. So if anyone has any questions, I'll just check. Could you go back to the unit clock slide, please? Yes, so we'll be sending a video out, but I'll just pop back to the units property clock slide. And you can see that Perth is in a declining market, but its unit market, and it's been sitting there for quite a while now. And Darwin, as I travel around the country, the reason I like to keep an eye on where Darwin's going with its market is that it's very tied into resources too. And so is Bundaberg up there. It gives me good confidence to see that Darwin's made its shift into its bottom of the market phase. And it shows that we're tracking at a very similar stage in both of our cycles, and that is and their market, interestingly enough, their unit market is a good 12 to 18 months behind its sale market too, and we're seeing that trend across Australia in the other capital cities as well. So any other questions before we finish up? I don't want to take up any more of your time than is needed, but I really appreciate all of you coming on tonight and sitting through our webinar. If you did happen to miss any of it, I'll be sending the video out. Jason, thanks for joining us. Jeremy, Dean, Eugenie, and all the others there. So really appreciate you jumping on board. And if you do have any final questions, pop them in now. Otherwise, we'll wrap up. And finally, I did allude to it. Our next webinar that we'll be running, I know a couple of you have been out to our Profit from Property Development seminar, but I'll be doing a very similar format to that, where we'll do a very quick market update at the start, and then we'll really launch heavily into different strategies, tips and tricks around property development, how to find that extra value twists in order to make money regardless of the direction of the market. Now, of course, we prefer to time our purchase so that we're buying with the trend in areas. So I will also list my top 2 to 3 suburbs for looking at areas suitable for property development. And that's coming up in approximately 2 weeks' time on Tuesday, the 5th of September, and you'll get an email in the next few days about that. So look out for that one if you want to join us. It'd be great to have you on. So no final questions. Thanks heaps for coming tonight. Really appreciate your company, and stay in touch if I can help with any of your property plans, okay?